The Federal Reserve is meeting tomorrow, and the consensus is they'll have a quarter-point cut to the federal funds rate. Now, just because this cut happens doesn't mean that we're going to have lower interest rates. They actually might go up, and here's why. The Fed sets the overnight rate. Now, 30-year mortgage rates, they follow long-term bonds like the 10-year Treasury note. They also find mortgage-backed securities. So there's different markets and there is different drivers. So tomorrow's quarter rate cut is already likely priced in. So it's not going to be a surprise. We're not going to see any huge drops tomorrow. The one thing is if the Fed starts sounding hawkish, meaning they're worried about inflation or they're signaling that there are going to be fewer cuts, that can affect the long-term yield, so that 10-year yield, and that might cause rates to jump up. So mortgage rates also track inflation. So if there is a report that comes out and there is a strong jobs report or spending data, likely what we're going to see after the meeting is that could push the 10-year Treasury yield up, and that in turn would hurt mortgage rates and push them up as well. So if there's uncertainty, those investors that are holding those long-term bonds, they're going to want extra yield. So they're going to want essentially a higher percentage if they're going to be holding those bonds, if there's uncertainty and if there's more of them out there, if the Fed's cutting back on their purchasing. The term premium is what they're going to be getting. That's going to raise the long rates. And with that, mortgages will also go up despite there being a federal rate cut. So interest rates aren't also just the 10-year Treasury. They also involve the mortgage-backed securities, and that's like the selling of all of these conventional loans are packaged together and resold. Now, as the market changes or they become more volatile, people buying them, they kind of want extra cushion from that 10-year yield to whatever the mortgage price is. So they kind of build that in. So your mortgage price is going to be that 10-year Treasury plus that extra cushion for those mortgage-backed security plus like lender fees. So that can also raise the final interest rates that we're seeing for the mortgage interest rates. So with that, besides the federal funds rate cut tomorrow, you're going to really look to see what's happening with the 10-year Treasury in comparison to the mortgage-backed security. If that widens, that gap widens between the two of them, we're going to see interest rates go up, even if that 10-year bond stays the same. With that, that just means that just because the Fed cuts doesn't mean we're going to see lower interest rates. And remember, a lot of these coming cuts that we know, they're kind of already built in. So we're going to see who really wants to buy these mortgages for these mortgage-backed security. That's really going to be a big play tomorrow. So don't just look at mortgage rates cuts.